The Chinese talking about dumping dollars. They've got a lot of dollars to dump. They've got over $1 trillion. So does Japan. The yen is getting killed. Chinese RMB is going down. The only way these currencies can go up is if they start selling their dollars. They start selling their U.S. treasuries. And what does that do? That pushes the inflation back to America, because now the dollar starts to go. Interest rates start to go up. I mean, the world has been, propping us up. We've been exporting our inflation. They can send it back to us by intervening in these currency markets, but by not hoarding U.S. dollars, moving away from the U.S. dollar, moving out of U.S. treasuries. Now, the Chinese were making some noise about doing that. I don't know. I mean, I've always thought that if they were going to do it, they wouldn't telegraph it first. They would just do it. You would find out that they did it after the fact. You would see the collapsing dollar. You would see the collapsing bond market. They wouldn't be talking about what they're going to do, right? Why would you do that? If you were planning on making a big sale, you wouldn't alert everybody that you were going to do it, because then maybe you wouldn't get a good price. People would start front running what you had intended to do. You want to take the market by surprise, right? You don't want to telegraph what you're going to do. You hope nobody notices it, and you get to do it, without anybody figuring it out. But of course, they're such a big player that if they really start to meaningfully move out of the dollar, people are going to figure it out. But you figure they want to get rid of as many dollars as they can before the word gets out that they're selling. The reason you have inflation, right? Governments create money, and you have spending. You have too much demand. Well, and you don't have enough savings. How do you change that? Well, if interest rates are positive, if I can earn a real rate of return, I'll save my money instead of spending it. Am I going to be incentivized to save money? I mean, yes, losing 5% is not as bad as losing 8%, but who the hell wants to lose 5%? If I know I'm going to lose 5% on my savings, I ain't going to save. I'm still going to spend. And so if the government is not cutting back on my spending, I'm still spending everything and saving nothing, they're not going to bend that inflation curve. You've got to encourage savings. Where is savings right now? It's the lowest it's been since the 2008 financial crisis. Americans are spending everything. And in fact, what does the government want to do? Gas prices are up. Oh, we need to give people more money so they can buy those, so they can pay higher prices. No, people have to buy less gas. That's what they need to do. We can't just give them more money to keep buying it. Then the price will keep going up. So the government is not allowing the free market to do what needs to be done. We're a lot poorer because the government created all this inflation. We've got an enormous government that we've got to pay for. How do we pay for all this government? Again, we don't get it for free. We're going to pay for it with a lower standard of living. Either we're going to have less money because the government takes our money, or we're going to have inflation because the government takes our purchasing power. That's it. There is no free lunch. Every time we get into a problem, the Fed covers up the problem with more monetary heroin, and then we have a bigger problem. And so we had a massive problem that erupted in 2008, and this one's going to be worse because we have a lot more debt now than we had then. That's why the problems weren't a crisis, because they hadn't developed to this degree. But now every problem is a crisis. That's why when they did QE the first time, they said it's a one-off event. We're never going to do it again. I knew in the beginning that that was a lie, that once they did it, they were committed. They had checked us into a monetary roach motel. There was no way out. I said it from day one. I said it in 2008, and I was right. And I warned about hyperinflation, and people were laughing at me because it hadn't happened. It just hadn't happened yet. It's going to happen, and even if it's not hyperinflation, it's going to be massive. We've already got the worst inflation in 30 or 40 years, and in fact, if they measured it honestly, last year was really the worst inflation ever. It was worse than any year. When the dollar collapses and it's no longer the reserve currency, and we can no longer act as a parasite on the world, we can't suck up all the goods that the rest of the world produces. Now the rest of the world is going to have a lot more stuff, and they're going to be better off. Right? The world is not better off because they're holding a pile of our paper. They're worse off. We're better off because we get their stuff and they get our paper. Well, when they keep their stuff and we keep our paper, the world is better off and we're worse off. And if the world is better off, then you're better off investing in those countries that are going to benefit from the dollar's collapse. You don't want to have your assets here because Americans are going to be a lot poorer at the end of all this, because we are living an artificially high standard based on the fact that the dollar is the reserve currency. Well, this crisis is going to end that reign. I think gold is going to replace the dollar. I don't think it's going to be the euro or the yen or the RMB or some special drawing rights coming out of the SDR. Everybody's going back to gold. I mean, that's where everybody always goes back to gold, right? Nothing has changed. If the money's creation slows down or reverses, everything implodes. So money supply is going to explode. There's no question in my mind that that is going to happen. It's already happened, and money supply is going to grow even more. In fact, since COVID started, I forget what 40% of the money that's ever been created has been created in just a couple of years. Well, when this next recession kicks into a higher gear, see, right now they're still pretending that it's not a recession because the unemployment rate officially is still low. Well, once the unemployment rate spikes up, they can't pretend anymore. But then the budget deficits are just going to explode from where they already are, which is a couple of trillion a year. And then, of course, the money supply has to follow, because how are they going to fund those deficits? They're going to create the money out of thin air to do it. Bitcoin and these other 20,000 fiat cryptocurrencies, that's all a sideshow. Yes, a lot of people got rich scamming people into this con, but a lot of people are also going to go broke. But at the end of the day, all that is doing is preparing the road for the real adaptation of that technology when it's married to real money, not these worthless tokens. All the places that people got rich during the bubble, that's where they're all going to go broke when the air comes out. And even if the Fed turns on the printing presses, the air's still coming out in real terms, because they're not going to be able to pretend there's inflation anymore. It only worked so long as they can pretend inflation was under 2%. They can't pretend that inflation is never going back below 2%. I mean, it will eventually, but in the foreseeable future, in the lifetime of the typical investor right now, you're not going to see it. It's not going to happen. What we experienced during the 2000s and the 2010s, that was a fluke. Right? What we're experiencing now, this is reality, and it's going to get worse. Inflation is going up, not down.
It doesn't make any sense that the markets continue to expect better numbers on inflation, yet continue to be surprised when those numbers come out worse than expected. Again, the classic definition of insanity, doing the same thing over and over again, yet expecting a different result. In fact, the insanity goes all the way back to the days when everybody just said inflation was transitory. Because I remember we'd keep getting a hotter than expected inflation number, and everybody said, oh, don't worry about it. It's going to go away. It's transitory. And so each time we got a new report, everybody thought that the number would be lower, and everybody was surprised when it wasn't lower or it went higher. And in fact, then when they kind of went from transitory inflation to peak inflation, every time we got a number that made a new high, they kept repeating the same phrase. Okay, now inflation is peaked. Oh no, now inflation is peaked. And now they just keep expecting inflation to go lower because the Fed has raised interest rates. We're now at 3.25%, and we have this slowing economy. And so everybody expects lower inflation, yet every month investors are surprised by higher than expected inflation. This high inflation is not going to go away. It's not going to go away anytime soon. In fact, it's not going to go away anytime in this decade. We have a lot of inflation in the pipeline, and we have yet to really begun to deal with it. Most people think that we're only suffering from the monetary policy mistakes made after COVID. And if the Fed had simply started hiking rates sooner and stopped doing QE sooner, we wouldn't be experiencing all this inflation. No, we would be experiencing all this inflation because the mistakes started decades before. We are paying the price for monetary policy mistakes going back into the early 1990s or even late 1980s. It's not simply the mistakes that were made after 2020, it was all the mistakes that were made prior to 2020. But another reason that inflation is not going to go away is because we still have negative real interest rates. Despite the tightening, we still have stimulative monetary policy. Even when the Fed hikes rates to 4% in November, you're still half the inflation rate. You're still discouraging people from saving and encouraging people to take on more debt. You are stoking inflation's fires. You're not putting it out. But even worse than the headline number was the core, because there the expectation was for a monthly rise of 0.4, which would have been a 33% reduction from the 0.6% rise in the core from the previous month. But instead, we had a 0.6% increase. That was higher than the high range of estimates, which went from 0.3 to 0.5. Now remember, the core is more important to the Fed than the headline because it strips out food and energy. Even though food and energy are probably the most important parts of the CPI, the Fed likes to ignore those and focus on everything else. But if you focus on everything else, that 0.6% rise is a big number. And in fact, the year-over-year increase came out at 6.6. That was quite a bit hotter than the 6.3% increase from the prior month and more than the 6.5% that had been expected. But in other words, we're going in the wrong direction. Core CPI is going up, not down. The Fed is getting further away from its goal of returning core CPI to 2%. In fact, we're still more than triple 2%. And again, what investors don't understand is we're not going to go from 8.2% or 8.5% inflation, whatever the peak was so far, all the way back down to 2% so easy. It's going to take a long time for inflation to return to 2%. Again, I doubt it's going to return to 2% anytime during this decade. For example, let's look at the inflation from the 1980s, because that followed the highly inflationary decade of the 1970s. Everybody likes to talk about all the inflation of the 1970s and how Paul Volcker got rid of that inflation by really raising interest rates, which he did. Interest rates went up to 20% in 1980. But remember, the highest the CPI got in 1980 was 13.5%. So we had 6.5% real interest rates, which really helped fight inflation because it encouraged people to save to earn those high real interest rates, and it discouraged people from borrowing because if you borrowed, you'd have to pay those high interest rates. So that really altered consumption and saving patterns, and that helped bring the inflation rate down. But it took a while because in 1981, the inflation rate that year was still 10.3%. And then in 1982, it fell, but it was still 6.13%. We didn't make major headway until 1983. And in that year, we had 3.2% inflation, still well above 2%. Now, granted, we had a more honest CPI back then. So a 3.2% inflation rate in 1984 using that methodology would probably translate into something that was less than 2% today. But of course, the 13.5% that we got in 1980 would have been nowhere near 13.5% if we were using today's CPI. In fact, the CPI in the last 12 months, I believe, if we measured it the same way we measured it in 1980, was actually higher than the 13.5% from 1980.